Thanks, Christian. It's really nice to be here. And continuing the meteorological comments, I'm from Toronto, and we're halfway. We get less sun than Madrid and Phoenix, but we get a lot less rain than Seattle and London. So it's kind of more of a in the middle. You can see on that slide, we have two corporate catchphrases, and one of them that we've written a lot about in the last couple of years is a different kind of value investing. So we're definitely with all of you in the value camp. But as I'm listening to all the managers so far today, it makes me think it's a big camp. It's a big tent. There are lots of different approaches. Fundamentally, it's value meaning present value cash flows. And you can come at it so many different ways. But today I want to talk about our other corporate catchphrase, which is a better kind of private equity. And that won't offend anybody here because we're all public investors. But my background before I set up Turtle Creek with two partners was running a private equity fund in Canada. And it was a successful fund. So we were successful private equity investors. But we decided we wanted to pivot to the public market. So I find myself a little bit in this current environment that maybe you've all experienced with your clients, with your investor base, obsessing on alternatives, obsessing on, I want to be in private equity, I want to be in, and we moved from that world because we thought it's a better environment if you're patient and you do the right things in the public market. So I want to talk about that and actually want to focus on a new fund, or I think I'm technically supposed to say strategy, that we created last fall for our investor base, and it's called the Turtle Creek Synthetic PE Fund. They're all public companies, but it is that subset, and we're going to have a lot of fun with it. Not only do I think the returns will be great over time, but just having that challenged conversation with our investor base about private equity, about alternatives versus investing the way we all invest in the public market. Really quickly, we manage $4 billion AUM, US dollars. We've been doing this for over 20 years. We are, in terms of our style, I think the way to look at us is we do the work as if we were going to buy the entire company. And the turnover of the companies we own, the changes, is really quite low over time. We're active, and I'll talk a little bit about that. And just so you don't worry that I'm only going to talk about a new strategy, I'm going to use that as a springboard into my investment idea that I think is a terrific opportunity right now. So what is this new strategy, and why did we create it? There were a bunch of things that happened last year. I had lunch with a very large family office in Zurich, and they told me that they do a lot of private equity, but they keep 10 to 15% of their portfolio in cash just to meet potential capital calls. And then in Montreal, and then I asked them, do you include that 10 to 15% cash balance when you calculate your returns in private equity? And they kind of said, no, we really don't. And then in Montreal last year, some people in private equity just commented there had been no capital calls, almost zero capital calls last year. So the LPs wanted to deploy capital because they knew it was a better environment late last year than it was a year or two earlier, but no deals were getting done. And if you know about the leveraged loan market, that market is still quite seized up. It was terrible last year. I know that in particular because large public companies that we own as Turtle Creek, if they were looking at doing dispositions, put them on hold because they said, well, basically private equity can't get deals done. They cannot get capital deployed because of the debt markets. So what we've done with this new fund is created a strategy that I think of as a private equity, even though they're all public companies, sleeve of what Turtle Creek does. So think of, we have a flagship fund that owns a whole host of different types of companies. Pure organic growth, cyclical, some financials, the good ones, but then what we call platform companies. So I think we all would understand what that means. So like a really, not a roll-up, but a company that creates significant value through accretive acquisitions. And again, the company I'm going to speak about is a classic example of that. So when you think about that subset, that new strategy for us, it's about 50% of the flagship fund. So it's a meaningful proportion, but then it's quite different. And then if you look at the advantages that we believe this fund has over buyout funds, it's a much lower multiple that we get to buy companies at. And then back to my comment, you're fully invested the moment that you want to put your money in. And maybe more importantly, in a sense, you have liquidity, not to take your money out, but if you wanted to deploy more money, you can do that on a monthly basis, which you cannot do when you've committed to a buyout fund. So the fully invested is important because we've all heard about the J-curve effect. People commit to a buyout fund, and you're paying your management fees on the total fund size before any of the money is drawn down. And then the final thing on that slide is we're pretty active in how we react to fluctuating share prices in the public market, and that's something that private equity cannot do because the companies aren't public. But there are two things that buyout funds do that I think is valid. One is they actually lever up companies to what I would call a more appropriate level. And I've had this conversation the last couple of days with meetings here in Madrid. And the pushback would be, well, we've got some Spanish companies that had too much debt and they went bankrupt. And so I get it. Sometimes companies clearly can have too much debt. But the counterpoint is, in the public market, and we hear this all of the time, companies are told constantly to have lower debt levels by some very big institutions. And I can only speak to the North American investor base, but I would be surprised if it were different here. They don't really give a good reason for it. They just want companies to have lower levels of debt. We're actually the voice in the other direction. We're frequently encouraging our companies to have what we would call a prudent level of senior debt. So you never have an issue, but at least you have a lower cost of capital. What buyout funds do is they go much further. They say, in the leveraged loan market, given the cash flows of this company, we could have 5 times, 6 times, or more debt to EBITDA. There's nothing wrong with that. It's why buyout funds exist. It's what KKR and their colleagues figured out 30 years ago. Companies can handle a lot more debt typically than an average public company manages at. So they'll acquire it, pay a premium, lever it up, run it. Nowadays, they actually, I think, in some cases, do improve the company as well. So that's the other pitch that buyout funds make, which is we buy undermanaged companies, undergoverned companies, we improve management, we improve governance, and then we take them public again. And actually, there are case studies within our portfolio today of firms that were owned by KKR and Apollo and Carlyle, where that you can see that evidently that is what they've done. So from our standpoint, what we're doing in this fund is we're countering those two reasons to put money into a buyout fund. On the debt side, we are using leverage, margin debt, at the fund level to approximate what a buyout fund would do, think of it as company by company. So today it happens that when you look at the portfolio of companies that are public that we own in that fund, it's at roughly 2.4 turns of debt to EBITDA. All right? So it's not a really low level, but it's nothing like buyout funds would do. And then we look company by company and say, well, if a buyout fund bought that company, what would they have it levered to? And we do that company by company, and that results in a target incremental debt at the fund level that, when you add it to what the companies actually have, gets you to approximating what a buyout fund would do. So we're neutralizing the advantage that a buyout fund has by borrowing money at the fund level. And when I started down this road last year on this exercise, I thought, but buyout funds have something that we don't have, which is they have access to the underlying cash flow of the company, which is why they can have those companies borrow as much as they do. But as I went through this, I realized, but we have something they don't have. We have a cross-collateralized portfolio of liquid, large, because our average market cap is 8 billion or so, large public companies that a bank, whether they should or not, will lend you a very high amount of money against the quoted share price. And so our target today in that fund is much, much lower than what a bank would actually be willing to lend to that fund. And if you then, call it back test it, or look at what would have happened in the COVID crash, which has been the most extreme decline that I've seen in a 1 month period since we started 24 years ago. The credit crisis was more in total, but it wasn't all in 1 month. This fund would not have had any kind of issue with the amount of margin debt it is targeting to have. So we're neutralizing the big advantage that buyout funds have. And recently, just last week, a Latin American family reached out and said, this is what David Swensen at Yale, so I love it if someone brings up David Swensen at Yale, has always talked about, which is if you levered the S&P 500 to what buyout funds are actually doing with the companies, the S&P 500 would have crushed buyout returns, even top quartile buyout returns. And then the other thing that, and again, I believe that good buyout funds do this, is that they improve management and governance. Our response to that is we've done the work to identify the few public companies that don't need improvement, that are well governed, that are really well managed. And then it's funny, and you'll all appreciate this. The other advantage that buyout funds have versus us, versus you, is that there's no mark to market. And people love the fact that they don't get bad news, even though there's bad news. And I met with a family yesterday who said, like, I get my statements. I know that it's not good right now in those buyout funds, but it looks great. Like, I'm down in the public market last year, and yet I'm flat on the private side. So that's an advantage that we can't counter. We have a quoted unit price, but I'm going to have fun with this because I'm going to write the reports. I'm going to write the annual letter for this fund as if we were owning private companies, as if we were just owners of companies. So that's the overarching strategy, if you will, that subset. But what you really want to hear about is our stock pick. So one of the largest holdings in this new fund, and actually the second largest holding in our main fund, is a Canadian company called Premium Brands. It's based out of Vancouver. When I thought about which company to talk about, our biggest holding is actually a U.S. company. More than 60% of our flagship fund is in U.S. companies. But I thought, coming here to Madrid, why not pick a Toronto Stock Exchange only listed company that, which is more likely to be well known or maybe not yet discovered by investors outside of Canada. This is truly a remarkable company. And when I put up the chart to show the returns that you've earned to be a shareholder of this company in the last 16 years, it's breathtaking in effect. When we first met them around 17 years ago now, they were this management team who had just taken over. So they're not the founders, but they think like founders. They think like owners. They took over a commodity pork producer based in the prairies in Canada and said, we believe in the following food trends, and they laid them out. And I hate trend investing, but I agreed with all the trends, but it's all about in the execution. And this company has executed over this time. It's the same management team. They continue to execute. And I wouldn't talk about it today as my stock idea if I didn't think it was really, really cheap, and if I didn't think at the current entry point an investor is going to do really well over the next 5 to 10 years. But think of a company that has pivoted from a pure commodity producer, which they sold, and now have 6 verticals. All of them are either past or at $1 billion in sales. So they started in meat products because they came out of that, the pork commodity side. They bought a family business in Washington State many, many years ago that had a contract with a company called Starbucks to make their breakfast sandwiches for the Northwest. They now have 4 plants around North America, which they've, beyond the first plant, built their own, so pure organic growth, and they supply every breakfast sandwich for Starbucks in North America. So, and they've struggled as they build more plants to diversify in that segment away from Starbucks, because every time they open a new plant, Starbucks is great, and they want to fill that one up too. So that's one vertical. They're in fresh seafood. They're the largest in North America. They may actually be the largest in the world. They own the product. It's not just, they're not just a distributor. They have control over the fresh seafood. Really smart management team. But the way to think about this company is, if you're a food entrepreneur, if you've built a really nice business, a local brand, a regional brand, taking share from the national brands, and then you get to the point where you realize your kids aren't going to come into the business. What am I going to do? And I've got employees I care about. I've got a company I've built and I love. This is the company. Initially in Canada, but now in the U.S., that word on the street is if you can get premium, if you can become part of premium, that's the right place to be. Because then they support you. They take away the crap that you've been forced to do as you've become a bigger company and let you get back to your roots. And it's a very decentralized model. There's support on finance, there's support on sales, and then they're left free to run their business. So it's a terrific model, and they do it really well. And so you can see, why is this a platform company? The way we think about platform companies, they've made 80 acquisitions in the last 17 years, spending $3 billion. But they have such a relationship with their, call it candidates, that late last year they put all of their planned acquisitions in progress on hold because they had to, their inventory was higher, they had safety stocks. You don't want to short ship Starbucks. So they just said, we're not going to close on these acquisitions until 2023. And as they said to us, these companies aren't going anywhere. It's not like they want to sell to private equity. They want to be part of this organization. So we think that they will continue to be able to build that base. I don't know if they'll develop more than 6 verticals, but they are constantly thinking about that. And so 5 years ago, or actually 4 years ago, they communicated they were frustrated with how short-term the public market is, so they communicated a 5-year plan. And they said that we're going to double revenue and more than double EBITDA in the next 5 years. And they're ahead of that. They've actually made it in 4 years. And then they just introduced a new 5-year plan a couple of weeks ago, which has them, I guess in a sense, almost doubling revenue and almost doubling EBITDA in the next 5 years. It's actually really the next 4 years. But if you look at this, you see it's all from organic growth, virtually all of it. In other words, we think it's a sandbag forecast. It's a sandbag 5-year plan. But it's striking to us that they think their organic growth is going to be 10% a year for the next 5 years. And one way to think about this, and I think whoever was talking about U-Haul, the same idea, the capital's been deployed. So through COVID, they've been hit with lots of challenges, like many companies have. There's been historic food inflation and a lot of commodity input, and yet they've continued to build out their capital base. So we think operating income can virtually double without any further capital being deployed. So it's, as I mentioned, it's listed on the Toronto Stock Exchange. It's big enough, so it's decent sized company. It doesn't trade like a $4 billion market cap U.S. company. It's one of the things we notice between Canada and the U.S. Americans are much more vicious in how they trade the companies that they own, and Canadians are less so. It has what I would call, this is back to this thought of inefficiency in the public market. It has an appropriate amount of senior debt. It doesn't have too much, but it also doesn't have too little. I remember telling the CFO once, years ago, about another company we own that great operators, but they actually had $100 million cash on the balance sheet and no debt. And he said, man, that's a really expensive cost of capital. And I thought that's the right way to think about how that company was running their business. Now, good news is we convinced them that was inefficient and that they were a target, and they fixed their balance sheet. It's the only company we own that pays a big dividend. And again, I think I heard a comment today, I hate dividends. I hate dividends. They're not tax efficient. They're especially not tax efficient in Canada, but also they're not tax inefficient in the U.S., but smart companies in the U.S. say, well, wait a minute, I've got long-term shareholders who don't trade the way we trade, and why would I pay them a dividend so that they have to pay tax, when instead I'll buy the marginal share, the owner that has the lowest opinion of what I'm worth? Isn't that the most logical way to return capital? If my longtime shareholders don't want to sell at this price, I'll just buy in the open market. So this is a company that has always paid a big dividend. And when I've asked the CEO about it, he's actually got a really good response, which is, I have, well, think about it, 79 companies. I have bought these companies. Sometimes I offer a bit of equity. Always they take some of their proceeds and they buy stock in premium brands. They have no idea what causes the share price to go up or down. And I don't have any idea either. But they understand if we make more money, if the operating profit goes up, if their division makes more money, we'll increase the dividend. And this company has a track record now of increasing their dividend by double digits every single year for many years. And again, I'm not a huge fan of it, but I do understand in this instance how powerful that is inside the company. It's trading at 14 times true cash earnings today, which isn't particularly cheap compared to some of the examples today, but we think those earnings triple in the next 5 years and then continue to grow significantly over time. So it's a value stock if you think about the present value of cash flows. And then finally, I mentioned that they pay a big dividend, and this morning I was looking at this chart where it shows 27% compounded buy and hold return. And I punched it in my phone on my calculator, and that is a 40x. So it looks like a 10x, which is really good. But because of that dividend, and because the dividend payout was so high in the early years when you see the black line, which is the share price, and then compounded returns assumes you get your dividend and you buy more stock. You just put it back into the company. And so while it's a 10x on the share price, it's actually a 40x if you had just simply reinvested the money. And then the bullet shows, because we're changing how much we own, the gray shading is simply the weighting in our fund, we've improved upon a terrific buy and hold by 600 basis points, which again, as a percentage of 27 doesn't sound like much, but I also punched that into my calculator, and it's twice as good as what a buy and hold has been. But here's the final point. You never know where the share price is going to go. And if you look at that share price when it peaked the first time 5 years ago, no one would have said, guess what, in 5 years the share price is going to be lower. But it was. And so if you just shrink into the last 5 years, even with the dividend you've received, in the last 5 years you've made zero money as an investor in this company, even though over 16 years you made 40x on your money. We've managed to do a little better than that, 5% a year, because of this dynamic activity around our holdings. But at core, we're going to own this company for a really long time. We're just going to own more of it when it's cheaper and less of it when it's more expensive. And so you can see in terms of the weighting, we own more now than well, it's hard to see, but we've bought a lot of stock in the last little while as the share price declined. So I think I'll pause there, see if there are any questions.
Any questions?
With your synthetic new fund, what sort of leverage are you putting in against the
Yeah, so I can repeat the question.
With your leverage synthetic fund, just curious what sort of leverage you're putting in, what's the cost of financing, is it with one bank, is it with a number of banks, and what sort of margin have you given for COVID style?
Yeah, no, it's a good question. When I started this last year, when I went down this road, I thought, well, I don't think we would be able to incur the debt that a buyout fund does because we don't have access to the underlying cash flows. But like I said, we have something that they don't have. We've got this portfolio of public, large, liquid stocks. Today, the target debt to get to where we would be proxying what buyout funds would do is 44% debt to gross assets. So in other words, if you have $1 of equity, you've got roughly 80 cents of margin debt. And we're using Scotiabank, that's our prime broker, but as this fund grows, we'll likely diversify that base. I mean, we're the counterparty risk, not them, right? So I don't mind just having one prime broker, but if this fund would become large, we would do it because they would want us to. They would want to have a more diversified base. But what banks do, I mean, I can only speak to Canada, they will lend 80% against gross assets. In other words, they'll lend you $4 for every $1 of equity. So we're at 44% target and below that a little bit. That's our max. So there's a huge amount of room between what we want to do and where you would have trouble. And if you go back and look at COVID, that crash in March of 2020, we wouldn't have come close to having an issue. The other thing and so then I would say to the bank, well, do you change the rules? Like, what if there's a crash? Don't you change the rules? Or are you going to give me a margin call for this fund? And they said, no, we never changed the rule. You can go back and look at what they did in COVID. You can look at what they did during the credit crisis. And as they said, there are lots of managers, hedge funds, that are using way more leverage in their strategy than what this synthetic PE fund is doing. And then your question about cost of funds, there's actually an interest rate arbitrage, which I'd never thought about in this, meaning, so our companies are investment grade debt. So like Premium Brands is borrowing senior debt on an investment grade basis. Then we're borrowing at the overnight rate, both in Canada and the States, sometimes 30 basis points more than the overnight rate, sometimes actually below the overnight rate. I don't know why. And so you put those two together, that's a much lower interest rate than what buyout funds are incurring in the leveraged loan market, if they can get the financing.
Thanks.
I had a question over here, just to your left. So you talked about kind of free cash flow per share is going to triple, I think it was.
Yeah.
Can you maybe just kind of flesh that out a bit more, give us a bit more detail? Why is that going to happen? They're well invested, but second.
So the tripling of free cash flow, it's really twofold. One is that 10% organic growth with actually very little capital outlay to get there. Like, they have deployed the money. And by the way, we've pushed them on this. I was talking to someone earlier who is a personal investor in Premium because he heard me talk about it a couple of years ago. And if you look at their RONA, if you look at the return on capital, it's still low double digits. It's not higher, even though their target, and they say every acquisition has met it, is 15% after-tax unlevered IRR. Well, you say, take that, you should have a higher than 12% RONA, right? But then if you think about the fact that they have been highly acquisitive, so they're constantly, from an accounting standpoint, making the RONA not look great. If they'd stopped, they'd have a much higher return on capital. And their point is right now, because of what happened with COVID, and the food input cost, the inflation, they didn't put their foot off the gas. They continued to deploy capital and support their employees, and that their earnings can, they say, double from an operating standpoint with no real incremental capital. So that's a key source of the free cash flow. But that wouldn't get you to a triple. So they're not saying a triple. If you look at their 5-year plan, it's more like a little more than a double. But this 5-year plan doesn't assume any acquisitions. Their prior 5-year plan assumed a lot of acquisitions, and they did them. And so I think in this instance, they're just giving the market a simpler, pure organic story. And I remember, well, when they came out with it last week, one of my colleagues who knows the company better than I do, he said, geez, we've got them at 1.4 billion in 5 years, and they're only talking about 1 billion. But then as you talk to them, you realize they're not counting acquisitions. So you get to a tripling through a combination of the organic growth and then assuming acquisitions. But our approach with companies is, if you've got a company that's made 79 acquisitions, they have an extraordinary opportunity set, and they say they're going to keep doing it. The funnel has never been bigger. To not assume that in a forecast to us doesn't make any sense. So, great.
Yes. So on a company level, so how do you approach, let's say, the appropriate level of debt or leverage in a way for that specific company? How do you determine that?
So are you talking now about the synthetic PE fund or appropriate for a public company?
For a public company.
For a public company. So here's my mental thought.
So what makes you confident,
yeah.
the right level?
So my thought is the CEO and the CFO go have lunch with the CEO of the bank, like Premium Brands, and say, we would like to, our target is to have 3 turns of debt to EBITDA. But if there's a COVID event, it might be above that. So we'd want a covenant that's higher. And the CEO says, that should be really easy. And then it goes through credit committee and it gets approved. In other words, think of it as a comfortable but appropriate level of senior debt. So none of our companies in our portfolio had any issues through COVID and the lockdowns. None of our companies had any issues in the credit crisis. So we're not advocates of go push the envelope as far as you can push it. We're not advocating to borrow the amount of money that a buyout fund would have a company borrow. We want our companies, though, to have an appropriate level, what we call appropriate, comfortable level of investment grade senior debt. And we fight this battle all the time because there are so many large institutions that, regardless of the industry, the nature of the company, the stability, have they keep trying to get companies that are public to have lower debt levels. They don't give a great reason. They just want them to have lower debt levels. My personal theory is a portfolio manager at Fidelity doesn't want to have to explain to his clients why one of his companies went through Chapter 11 of his 50 or 60 holdings. And so he just tells his companies, I don't want you to have very much debt. So that's how we think about it.
Last question.
Hello, congratulations for the presentation and for the stellar returns. I have 2 questions, if I may. First of all, regarding your let's say, the new strategy. If I'm not wrong, doing my calculations, maybe if you are in a downturn, minus 55, minus 60%, you'll be able to put additional collateral, if I'm not wrong. And then, with the size and with your track record, why do a synthetic fund instead of, for example, trying to go on the board of companies and push them to do that? Because at the end of the day, you have a collateral that moves, and if you have debt that comes collateral that doesn't move, it's much easier and much more stable.
Right. So I can answer the side. What was the first question again?
The first is, do my calculations more or less what bonds lend. If you go to minus 55%, you'll have to start selling your positions.
Yes. Okay. No, that's exactly right. So if our portfolio of companies fall by 55% with that kind of leverage, the bank would then say, margin call, and you'd have to sell some stocks. And that is the point, though. That hasn't happened yet in our 24 years. Even in the credit crisis, our portfolio didn't go down that much, and it happened over a year plus. And in COVID, our portfolio went down a little more than 30%. And the other point would be, as you come into those periods where share prices are higher, we wouldn't be at 44% debt, we'd be in the 30s, because it's not a percentage of the share price, it's a targeted dollar amount of debt. And that means if the share prices were all higher, as they were pre-COVID, for this portfolio, it would be 30% debt to gross assets. We're not targeting a percentage, we're targeting a dollar amount of debt. And then your second question, I did that in private equity, I was on boards, I don't want to do that. And we would never go to a public company and say, you should have the same amount of debt that you have when you're bought by private equity. I mean, look, our biggest holding, I'll leave you with one last thought, our biggest holding, they now have an announced range, even lower, 2.5 to 3.5. And yet, you sit behind the closed doors with the longtime CFO, and he has said to us, for my company, if I would have it at 6 to 7 turns of debt to EBITDA, which sounds really high, but this is a global recession-proof company. And he said, the lenders would give it to us. We've been borrowing in the public debt markets in the US for 25 years, but we're public. And so we're not going to the companies and saying, you should have that much debt. We're simply going to our investor base and saying, if you like buyouts, you should love this fund. We're trying to compare it with a buyout fund. I was hoping to try to bring the time in tighter,
Perfect.
but I
No, that's
really
fine.
screwed
That's
up. So
No, don't worry. Thank you so much.